Hello and welcome to our monthly trade floor update. My name is Hugh Holden and I'm joined this month by Portfolio Manager Rob Mead. Rob, in November, the Reserve Bank announced a cut in Australia's cash rate to a record low of 0.1%, along with a range of other easing measures. Can you share your thoughts on the monetary policy settings and the implications for investors?
Thanks, Hugh. As you say, the RBA has recently committed to more monetary stimulus via cuts to the cash rate, the 3-year yield curve target and the term funding facility available to all banks, all the way down to a record low of 10 basis points, as you said. And Governor Lowe again indicated that the RBA doesn't expect to increase the cash rate for at least another 3 years. The RBA also announced some additional balance sheet usage to the tune of at least $100 billion. This will be done via regular purchases of government and semi-government bonds over the next 6 months. And the $100 billion will be all done in the secondary market and will be targeting the 5 to 10 year part of the yield curve. The recent purchases also show that they're willing to buy bonds out to at least 2032. We also know that the RBA will continue to support their 3-year yield target, and any bonds that they purchase in that part of the curve will be separate to the announced $100 billion. So I guess given this unprecedented policy support, the implications for Aussie investors are that interest rates will stay lower for even longer, and term deposit rates will continue to fall as banks can access this medium-term funding through the term funding facility at exceptionally low levels. So I'd say the most important takeaway is that it's time for investors to think more creatively about income generation, and doing that by purchasing things like highly liquid credit assets, but also being willing to lock up some of the portfolio for a few years potentially in order to capture some illiquidity premium and also access potential expected returns in the high single digit range, I should say.
Thanks, Rob. And of course, the other big talking point this month is the US presidential election. So could you please share with us your thoughts there and what it may mean for investors and credit markets moving forward?
While the US election definitely remains noisy, we think the most likely medium-term outcome is going to be supportive for markets. A narrow majority means fiscal policies will be measured and tail events should be less likely. Monetary policy support will obviously continue to be necessary, meaning that interest rates will stay lower for longer and potential for inflationary scenarios remain low, and we should see that anything like that delayed until the back end of PIMCO's 3 to 5 year secular horizon, and if it happens at all. Also, in the near term, we think the election outcome plus the policy backdrop should be supportive of high quality credit assets. As you can see, they continue to offer spreads that are multiples of expected default rates, unlike some of the assets further down the credit curve. So with the US election pretty much behind us, we are closely monitoring the rise of virus cases and also the progress on vaccine development as key drivers of economies and markets. And as a result of that, we still remain cautious in our portfolio positioning, retaining that high quality bias, being very bottom-up oriented and trying to avoid generic risky credit beta.
Thanks, Rob, and thank you all for joining us. If you do have any questions or would like any further information, please contact your local PIMCO account manager or visit our website at www.pimco.com.au. Thank you.